China, the country might not be battling steep inflation like the US and the UK, but it has other problems. A factory of the world is suddenly witnessing lesser customers for its products, both domestically and internationally. Trade tensions between China and major economies such as the US are also hampering growth. Now, in the middle of all this, if you are invested in Edelweiss Greater China Equity Offshore Fund, what should be your strategy going ahead? Or if for diversification, does the fund hold a chance to be a part of your international diversification? To talk on all of this today, I have with me Niranjan Avasthi, Head Product Marketing and Digital Business, Edelweiss AMC. Niranjan, good evening. Welcome to the show. So let's talk about China's economy to start off with. China's economy is slowing down as it adapts to a punishing zero-COVID strategy and weakening global demand. We are looking at heavy losses in 1 year time horizon if we talk about the fund. What would be the reason to stay invested from an investor's point of view, Niranjan?
Thanks, Kavita, for having me. It's great to be talking to you today, especially on China, because as you rightly mentioned at the beginning remarks of your talk, that China has its own problem. The problems in China are very different from what's going on in the world. So let me just give you a background of what's happening in China over the last 1.5 years. If you recollect till 2029, the beginning of 2021, China as a region was doing very well. It was one of the best performers, best performing equity market over the last 2-3 years till early 2021. At that point in time, the entire world was battling with pandemic issues. China was one region which was kind of out of that worry, and government was stimulating the economy, and it was doing very well. Over the last 1.5 years, government started its, taking the equity dividend and using it to get some regulations in place, especially on the tech side. It all started with that when the equity market, especially the tech side of China market, started feeling nervous, and investors started testing, tough times. Post that, more recently, if you see, two more developments had happened in China. One is after a very long time, China had seen a huge spike in COVID cases. And as you would know that, and everyone would know that China has a very strict COVID zero policy. And because it's a socialist government, they have a very stringent policy around it. And there were a lot of lockdowns, because of which the GDP growth had taken a hit, and the normalcy was not there over the last couple of months or quarters. The third point, is what's happening in the China real estate market. Now, real estate market for China is very important because it forms almost 70 to 80% of its GDP. Over there is a clear sign of slowdown, and these are the three reasons why over the last 1.5 years, the fund and the region, which is the Greater China region, has not been able to perform well, and it's been an underperformer. Over last 1 year, if you see, however, it's down mostly in line with other international funds, especially US focused funds or international focused funds. However, if you calculate the performance since last 1.5 years, it's down a bit more, maybe around 15-20% more than other international funds, for the reasons which I just alluded to.
Right. You've really highlighted the most stressing points from an investor's perspective, Niranjan. But then, as we all know, that this fund invests in JP Morgan Greater China Funds, an equity portfolio that has diversified investment approach of companies which are in China and Taiwan region. Now, looking at the current political tussle between these two regions, along with the slow growth, if we talk about what all Mr. President said, so Mr. President affirmed the need for the country's recent shift away from rapid growth and towards greater focus on national self-sufficiency, especially in tech. Where does it leave the fund in this new change economic outlook and the kind of statements that we've been hearing from Mr. President coming?
So if you see, this stance of the Chinese government is not new. In fact, if you see over the last 2-3 years, what has happened in China is China has realize that their dependence on export needs to come down. And that is the reason China is more working towards getting the economy back on track using the domestic consumption story, because China is a huge population. Over the next few years, they're going to add almost 500 million middle class population to their, kitty, which means there is a huge consumption story which is building up in China, and government is focused there and would do a lot to expedite that growth. The second is because of the US-China trade war. Another important area for Chinese government has becoming self-sufficient in terms of technologies. Now, if you see semiconductor, which is the new fuel today for a lot of countries and the entire world, it's a new oil for economies to keep on going, and that is where China has been focusing more. It is focusing more on building self-sufficient technology. For example, the import of chips has reduced a lot in China. They are becoming self-sufficient. Now, this fund particularly is largely focused on what China can do over the next few years, looking at the threats which we all know, that the trade war which is going on, the China plus one policy which is there, which means some of the manufacturing partners with China, which have been using China labor force for many years, are shifting to other countries. All these has been kept in mind when the portfolio manager of JP Morgan Greater China Offshore Equity Fund has created a portfolio. And largely this fund is focused on three key themes. One is technology, which is revolving around creating self-sufficiency, and also the technological advancement which we have seen in the China region. If you see, China as a country has filed more patents on the technology segment compared to US or any other developed world. So clearly technology is a space where China is doing very well and will continue to do well. The other theme is the consumption theme, where, as I just mentioned, China is going to add almost 500 million middle class population to the economy, and that will lead to a large consumption spiral over the next few years. That is where the fund is focused. And lastly, becoming carbon neutral is on the agenda for many countries, likewise in China. And that is where a lot of things are happening. China has been at the center stage when you look at the manufacturing of solar panels or maybe electric vehicles. China share on solar, ecosystem creation is more than 80% in the world. If China sells half of the electric vehicles which are sold in across the world, last 2021 they sold almost 2 million electric vehicles, which was more than put together all developed worlds and the entire world. So even on the carbon neutral space, China is doing very well. And there is a longer story which is getting unfolded. So all these are the three themes where the fund is focused, which we believe over the next few years will unfold and will have many opportunities for wealth creation for investors, and which will definitely reflect in this fund.
About tech over here, because what's happened is China's tech titans are actually losing investors, since the regulatory crackdown, which has lasted for almost more than 2 years now. We've seen a severe dip in terms of revenue and profit in these tech giants, if I can call them. So what exactly are we talking about in tech, and why is the outlook so optimistic according to you?
See, one of the basic reason why there were regulatory changes and there were maybe so-called crackdown on the tech giants is China wants and clearly it comes from what the government has mentioned in their statements, is basically they want a level playing field and not a monopolistic ecosystem. Most of these giants were becoming very, very large, and they felt that this is a time when there should be a regulation. They should not be exploiting because of their monopolistic position, and create a field where newer players can come in and they get a breeding ground to grow, because while these are tech giants, there is a huge scope for even other tech companies to come and join the ecosystem. So that was the thesis. And in fact, if you look at the data, there is a rise of many other technology companies which are getting into the market over the last few quarters, and that was the focus. So while the giants have taken a hit, I think so the level playing field which the government has been or trying to create is a larger goal which they would be able to achieve over the next few quarters or years.
Let's talk about intense competition that we see coming from the US. The Biden administration has called China a strategic competitor, and this month announced new export controls on semiconductors. Now, in an effort to maintain a US edge in tech over China, how is it likely to impact the overall sector and the outlook?
So as I mentioned, tech, there will be some shifts as far as technology is concerned. And that is where China is more focused and also concerned at the same time. One example which I gave is, the chip shortages which have been doing rounds. Now, in last, 6 months or a year, in fact, there have been a large improvement as far as the chip manufacturing is concerned within China. And that is where they are trying to create a substitute for all these key technologies within China, whether it is chip, whether it is other semiconductor products, whether it is, the electronic panels and all, which were, kind of imported and China was dependent. China is creating that ecosystem, and many companies are thriving to get their own share within China for this. So, broadly in the medium to long term, this will actually help the region to become self-sufficient. At the same time, the focus would also shift only to being a manufacturing kind of country to becoming a technology leader, at least for the region which they are catering to, which will help the economy grow and also bring up a lot of interesting investing opportunities within the region.
So now when it comes to diversification, and if we talk about international diversification, would you still recommend investors to stay invested in this fund?
So currently, if you see, people who have invested in China, of course, they've seen a drawdown in their portfolio. Today, as we speak, because of all, what has happened in last 1.5 years in China, the valuations are at pretty cheap levels. At the same time, at least for the domestic driven companies within China, the growth prospects over the next few years is quite interesting. One analysis by the JP Morgan team says that over the next 5 years, the expected growth rate for this portfolio would be close to 20%. At the same time, the valuations today are pretty cheap. If you look at the Chinese price to book value, it's trading close to 1.4, 1.5, which is probably a decadal high, which we have seen levels during the global financial crisis. At the PE level, it's trading somewhere around 10.5, 11, while the ROE for the region is close to 11. I think so China is the only country today which is trading at this cheap valuation, while most other countries are also facing some of the other problem. Not what China is facing, but at least on the inflation side. China is a country where there is no inflation worry. It's probably the only central bank which is cutting rates, is trying to stimulate economy. It's probably the only government which is doing huge tax cuts without worrying about any inflationary measures. So while the problems are different, the solutions are also quite different, which the Chinese government regulatory regime as well as the central bank is using. So from that perspective, actually, it's a good time to in fact add on to your investment. At least if you're not adding, this is not the time when you should exit. At least give it a year or two and let the things settle so that markets stabilize. One thing is very important is in investing, the opportunities are only created when there is a huge flurry of bad news. And China has been just that over the last 1.5 years. For investors, and I'm sure there are a lot of investors who might not have invested in China, this could be a good opportunity. One thing, however, I would like to highlight is if you are investing in a country or a region like Greater China, volatility would be there. In fact, volatility could be a bit higher than any other emerging markets like India or Southeast Asian countries. and you should have appetite to, digest that volatility, because over the last 10-15 years we have seen Chinese equity market had sizable drawdowns at least every 2-3 years. So if that is not a worry, or that is the risk appetite which you can, which you have, I don't think people should be worried about their investment at this point in time. In fact, they should add more and let the investment grow over the next 2-3 years, or at least few years. Most investors, by the way, we have seen in investing in Chinese, or at least Chinese equities, or at least in our fund, in only last 2 years. So they've not even, I would say, stayed invested for the minimum time horizon which we usually recommend for equity investing, that is 3 to 5 years. I think so over the next 3 to 5 years of their investment cycle, things would be quite stable and hopefully rewarding for many of these investors.
In the middle of all this, don't you think India has a better growth story where investors can maybe go bullish, aggressive, and bet more on the 10-decade, one entire decade story that we're talking about for India these days?
Yeah, absolutely. I mean, the opportunities are equally there. But, when we diversify for a different reason and not only for absolute returns. When we invest outside India, like in US, we definitely know we're going to grow maybe at 2x or 3x of what US as a region would grow over the next 10 years, but we still invest. So investments are rather for diversification and not only for absolute returns. I think so China gives a good opportunity to diversify our investment outside India. If you look from a distance, India as well as China had a similar story, while China has been maybe a decade ahead of India, but the demographic, the opportunities are equal. And I think so it's a good way to diversify in another potential superpower over the next 10 years. I would actually personally look at that way rather than India versus China, or maybe US when it comes to international investing. It is India plus China, or India plus in US. How do I maximize my benefit, and how do I diversify my portfolio?
So here, for diversification, you can bet on Edelweiss Greater China Fund, but then your time horizon needs to be for at least 5 to 7 years. That'll be all. Thank you so much, Niranjan, for removing time and getting into the details for this fund. We will slip into a short break, and post that we'll tell you how smart is it to have an index fund in your portfolio, and what kind of index fund should you actually be including in your portfolio given the current market scenario.